We're going to be talking about 1031 exchange and replacement properties. We'll have a nice little focus on replacement properties. A couple of things I want to let you know that this webinar is being recorded and it's going to be sent out at after the conclusion. So if you're not comfortable being recorded, you can log off now and we will be sending it to you. But note that if you stay on, you'll be recorded. If you ask any questions, I will be monitoring the chat throughout the session, so feel free to ask questions in the chat. You're also welcome to turn your mic on and turn your camera on if you'd like, and ask questions that way. It's going to be a small group, so we can certainly make it more of a discussion, and you can ask examples as you need them. So in saying all that, this should run for about 35 minutes or so, and then we're going to leave some time at the end for questions. My name is Michelle Fitzpatrick, and this is Northern 1031 Exchange. Northern 1031 Exchange is a wholly owned subsidiary of Northern Bank. We have been processing qualified 1031 exchanges since 2015. And we have a team of people that handle our exchanges. So we're going to kind of get right into it and talk a little bit about 1031 exchange. So a 1031 exchange is an IRS code. Pretty simple. It basically just says no gain or loss shall be recognized on the exchange of real property. And real property is really the key word here. So it is specifically for real estate. And it's real estate that's held for business use or investments. And you will not be taxed on the profits if you replace your property by buying another property that's held for productive use in a trade or business or for investment purposes. So that's what the code says, and we're going to get into really the details. So we are based in Massachusetts, so I'm giving you a Massachusetts example. These are all of the taxes that investors would face if they didn't exchange. So I'm not entirely sure if we have attorneys on the line. I think I see a couple of attorneys and a couple of realtors. So, and you know, if you're an investor yourself, but these are the taxes. If you do not do an exchange, a lot of people say, you know what, Michelle, I'm going to just sell the house and I'm going to pay the 15% capital gains taxes. It's easier and I don't really want to deal with an exchange. And the reality is that that's not the case. There are a lot of taxes that you would be taxed if you don't do an exchange. So of course, there is that capital gains tax, which is the 15 or 20%. And most often when people are selling their property, they're usually falling in that 20% range. So capital gains tax is 15 or 20%. Then you have what's really the big one is this depreciation recapture. So all of the depreciation that the IRS has allowed the investor to take while holding the property, they recapture all that depreciation at 25%. Often cases, we have a lot of clients that will come in and say, you know what, I've held this property for 20 years, 30 years, whatever it is, and I'm ready to sell it now. They've depreciated their property for 30 years. The IRS is taking all that depreciation back at 25%. So that's a pretty big nut right there. Another couple things that people don't realize is that there's an NIIT tax, or net investment income tax. It's also called like it's like a Medicare surcharge, and it gets tacked on to any sale, and that's at 3.8%. And if you're in the state of Massachusetts and selling in the state of Massachusetts, you have a 5% income tax. That changes from state to state, but you know, we add all of these up, and it's usually around 30%. So if somebody's selling a property, they're going to pay about 30% in taxes if they do not exchange. So that's where we come in. And I always like giving this little breakdown on what a sale is versus or if you sold the property and didn't exchange. And it really just breaks down what those taxes were that we just talked about in the previous screen. So, you know, this is just an example. If a client purchases a property 10 years ago for $500,000, and now they're going to go and sell it at $1.2 million, what they're going to end up paying in taxes is $215,000. So it gives you the NIT tax, the depreciation recapture, the state tax, all of that comes out to about $215,000. So pretty substantial, which is why we're always encouraging our clients to go out, find replacement property, reinvest their profits and their proceeds into a replacement property that suits them better. So we're going to talk about what properties suit people better. And we'll get into those replacement properties, but I wanted to kind of give you an idea of the types of exchanges that are available to clients. There are the obvious, which is that the delayed exchange, which is what we do. So you sell your property to one person and then you purchase a property from somebody different. There are typically 3 parties involved. There's a qualified intermediary involved, which is what we do. And you that's typically a forward exchange, delayed exchange. The 2-party swap is like finding a needle in a haystack. It really is when you have a property that I want and I have a property that you want and we swap them. It doesn't happen all that often. That's really how the exchange started back in 1921, when the IRS put 1031 exchange in the tax code. So it's been around for a really long time, but that doesn't happen too often anymore. People are allowed to also exchange, meaning from multiple properties. So they can sell multiple properties and purchase one, or they can sell one property and purchase multiple properties. So, and there's really any combination of that. Reverse exchanges, and we're not going to get into detail too much about this today, and that may be something that we do on a different webinar. But a reverse exchange is when you purchase your replacement property first and then you sell your relinquished property. So a lot of people come to us and say, listen, I have a property, my dream property, it's under agreement. The seller is not budging on the closing date, and I really want to get this, but I want to sell my property after the fact. And we can do that. So that's a great option for tough markets, when the market's really hot, like it was over the summer, and people are buying properties really, really quickly, and they're not even, staying for a day on the market. Reverse exchanges work really well. Improvement exchanges, if you're selling $1 million property and you find a beautiful $750,000 property that needs work, you can do an improvement exchange. You can take that remaining $250,000 and put it towards improvements. And again, that's something that we can talk about at a different webinar, because we can get into real detail with that. But that is something that is available as an option. Personal property is now excluded from 1031 exchange. So as of 2018, you can no longer do personal properties. So boats, RVs, things like that do not qualify. However, boat slips do. So anything that's deeded, if you have a deeded property, that can be exchanged. Again, feel free to chime in if you have any questions along the way. So this is how a delayed forward exchange works. This is really the flow of it. So you have your taxpayer or the investor, the person that is selling their relinquished property and doing an exchange. So that taxpayer will engage the qualified intermediary, which is us. So the qualified intermediary has to get engaged prior to the closing of the relinquished property, prior to the sale. Oftentimes we're getting involved when people have a purchase and sale agreement or a buyer lined up to purchase their property. Sometimes people call us the day of the closing and say, you know what, I just found out about an exchange. Can we get it done? We can certainly get it done. Attorneys don't really like changing HUDs and having this curveball thrown in the last minute, but it's certainly doable. So we can get exchanges done up until the 11th hour. But we like getting involved where everybody knows that there's an exchange happening right around the purchase and sale agreement time. So taxpayer engages that qualified intermediary and they find a buyer for their property. At the closing, the deed gets directly deeded from the taxpayer or the seller to the buyer. However, the proceeds go right from the buyer to the qualified intermediary, never touching the taxpayer. Taxpayer and investor cannot have constructive receipt of the funds. So they go directly to the qualified intermediary, which now starts their exchange, starts their clock ticking. They have 45 days to identify a replacement property, and they have 180 days total. So that 45 days is built into the 180. So they have 180 days total to find a replacement property and close on that replacement property. At that time, qualified intermediary sends those proceeds directly to the seller to purchase that property. Seller directly deeds the replacement property, directly deeds back to the investor. That completes the entire exchange. And the taxpayer or the investor is essentially going to just report that 1031 exchange on their tax return for the year that they sell their relinquished property. So right now, as of October 4th, you could sell in the year 2022 and then not purchase until 2023. However, you should know that the tax has to be reported in or the exchange has to be reported in 2022. We touched on this on previous slide, but I just want to reiterate, 45-day identification period. You can identify properties up into the 45th day. After the 45th day, you cannot change your identification. You either have to purchase one of the properties or all of the properties that you've put on your ID form, or your exchange fails. So by the time the 45th day comes, you want to be pretty sure that you're going to be able to acquire one of the properties that you've identified. 180th day, you have 180 days for your exchange period. And so you have to close on one of your properties you've identified within 180 days from the time that you closed on your relinquished property. That's never the problem. That's always usually pretty easy. Extensions are not normal. There is, however, an extension that just came out today for anybody in Florida. So the entire state of Florida has an extension granted for both the 45 days and the 180 days. So it's a person that resides in Florida or owns a business in Florida. And there are extensions that have been for the 45 days and the 180 for people that have identified properties in Florida. So if anybody has properties in Florida and want to talk about that a little bit more in detail, we can talk about that offline afterwards. I just got it. I just received it today, so I haven't gone through it in detail, but that is available. However, in saying all that, typically the 45 days and the 180 days, those are hard numbers. They do not get extended. Otherwise for natural disasters like Hurricane Ian. Here are some exceptions to the 1031 exchange properties. So you cannot exchange your personal residence. Again, this is used for investment purposes, for properties that are held for investment use or business use. You cannot exchange your second home. So vacation rentals would work, but second homes do not. You cannot exchange stock and trade or other properties purchased for quick resale. So those people that are flipping properties and that do it as part of, if developers that do it as part of their business, and that is their business, that is not exchangeable property. Stocks, bonds, notes, again, not exchangeable. Interests in partnerships, and this is something that we talk a lot about. If you own a property in a partnership or in an LLC with somebody else, and you want to go one way and the partner wants to cash out and you want to exchange, that is a very difficult division. It's something that you want to start considering well prior to selling. So tenants in common are the best way to own property with partners or with other people. It's the easiest way to exchange property is if you are tenants in common. Partnerships are very difficult. And certificates of trust or beneficial interest. So like REITs are not exchangeable property. Like kind, I'm going to just kind of talk about this very, very quickly. Like kind just means real estate for real estate, deeded property for deeded property that is held for investment purposes. It does not mean that you sold a single family house and you have to buy a single family house, or you sold an apartment complex and you have to buy an apartment complex. That is not it at all. You can buy any deeded property held for investment purposes. So if you sell a condo, you can buy a farm. You can buy a commercial property. It really doesn't matter. So this is where we're going to start talking a little bit about the replacement properties and some options for replacement properties. It has been a really tough market in the last 2 years. People are going out, they're looking for properties, and they're really, really struggling. They're having problems. Properties are coming on the market, and they're, the minute they come on, they're under agreement. They have the investors are going up with against other investors with multiple bids, multiple offers, well over asking price. So our clients have started to get creative in their replacement properties. A lot of clients will come to us and say, I've been a landlord and that's what I know. I'm going to just go out and buy another condo or buy another 2-family that may just be in a better location, or that may be more updated than the one I have, but that's what I know. And they're struggling to find those kinds of properties. So we always encourage people to be open to different types of replacement properties. And vacation homes, vacation rentals have been a really popular alternative for people. People that, like I said, have been renting out 2-family homes are now getting into vacation rentals and buying properties down the Cape. Florida is a really big place that people have been buying properties. And the IRS has created what we call a safe harbor. So when you buy a vacation home, if you follow these rules, the IRS will not question your exchange. They will classify your property as a vacation home as opposed to a second home, which, as I said earlier, does not qualify. So the vacation home safe harbor says this. You have to hold your relinquished property and have rented it for the 24 months prior to selling it. And then when you purchase your replacement property, you have to rent it for at least 2 weeks a year, and you have to restrict your personal usage to 2 weeks per year. So, seems pretty easy. A lot of people are always asking questions about how would the IRS know? How do they know if I'm using the house? How do they know if I'm renting it out? So here's kind of the answers to those questions. You should be reporting the rental income on your property for as rental income. So you should be reporting that on your taxes. You do need to rent it at fair market value. And if you are renting to a family member, that family member has to classify it as their primary residence, and it has to be at fair market value. So you can't just rent it to your son or your daughter at $50 a week and put it on your tax returns and think that that's going to suffice. It will not. So you do have to rent it at fair market value to a third party. And we always recommend our clients to keep a log of when you actually go to the house. A lot of people that own vacation rentals will go to the house more than 2 weeks per year. And it's because they're going there and they're working on the property. They're getting it ready for another tenant. They're cleaning it, they're renovating it, they're landscaping it, they're painting it. They're doing all sorts of maintenance tasks to keep their property rentable. So that wouldn't be considered personal use. That would be considered work time. So we always recommend our clients to make sure that you log what you've done in those first 2 years. So if you ever do get audited, you have a trail of what you did when you did it, and try to fall under that safe harbor. So there were a couple, and I just gave an example. There were a couple times where exchanges have been questioned and challenged by the IRS, and sometimes they've won, and sometimes they've, the investor has lost and have had to pay the taxes. So we don't even have to get into detail about it, but we just, taxers are self-regulated. You have to make sure that you're doing the right thing. We're going to give you the information as qualified intermediaries. We're going to give you the information to make sure that your properties qualify and that you're doing the right thing to make sure that your exchange stays valid. So moving on, I wanted to tell you a little bit about Delaware Statutory Trusts. And this is something that a lot of people do not know about as replacement properties for 1031 exchanges. So Delaware Statutory Trusts, and this is the definition, and this was provided by Blue Rock, which is a sponsor that many of our clients have used in the past. So it's a distinct legal entity created under Delaware law that permits a fractional ownership of real estate assets that may be used in a 1031 exchange. However, to use a DST in a 1031 exchange, syndication programs must comply with the requirements of the IRS. So what it really is saying is that you are buying a fractional interest share or a tenant in common share in a larger piece of property. For example, there are Amazon distribution centers that are $100 million. They're 100,000 square feet. They're gathering investors, and you could put $100,000 in and just buy a fractional interest share. And that will satisfy your 1031 exchange. So the IRS recognizes that as a valid replacement property. And make sure to note that it is different than a REIT, a real estate investment trust. Similar concept, but REITs are set up where you are buying an interest in the actual trust. The DST, or the Delaware Statutory Trust, you are buying an interest in the property. You are buying a tenant in common interest in the actual property. That's where the difference is. Here are some general guidelines to buying into a DST. So you'll have access to more investors in more legal structures. There's a lower minimum investment amount. So you don't have to put in, if you do $1 million exchange, you don't have to put in your whole $1 million. You can put in, some of them have like $100,000 buy-ins, $50,000 buy-ins, $200,000, whatever the number is. So, you can put just a small percentage of your exchange into a DST. It really is fairly simple and efficient when it comes to it. So we have clients that work with a DST. These are sold by, they're sold by a financial specialist. So they're working with their financial specialist or a DST advisor, and the paperwork comes through, it gets signed off, and it's pretty simple. So it's not like going through an entire purchase and sale agreement and looking for properties. You are looking at a portfolio of different DSTs that are available, and you are choosing one that works right for you, depending on the debt coverage, depending on the location, depending on your, the return or the type of property that you like. And they can go anywhere from a multi-unit apartment complex to a single tenant like an Amazon, to a medical office building. Lots of different varieties of DSTs that are available, so you find the one that's right for you. One of the nice things is you're not going out and getting a loan. The lender makes one loan to the DST, and then you may be assigned debt. And we don't have to get into that, but that's really a nice feature. So like I said, the loan carves out and applies to sponsors, not the investors. So it's a non-recourse loan. So the loan goes on to the building, non-recourse to the actual investors. The sponsor makes all of the decisions. So the investors, they don't make any decisions on the property. There's no decisions on when the property gets sold. There's no decisions on what the financing is. It really is a very passive income strategy. It's a very passive investment. You don't have to make a special purpose entity. We don't really have to get into that. But when you consider a DST, here are some things that you want to think about. It gives you the opportunity to own institutional or a portion of institutional grade property. So you're not limited to just buying another condo or just buying another two-family or just buying something that's in your neighborhood. You really get access to a lot of different types of properties that you wouldn't otherwise have access to, which gives you the ability to diversify your portfolio. So if you do have a bunch of multifamilies that you're renting, this gives you access to something that's different. It really is a turnkey solution. The sponsor handles everything. So you are collecting a check. We call it mailbox money. You're collecting a check at the end of on a monthly basis. I already talked about fast and efficient closing processes. Because DSTs are always available, there's always something to choose from. So you'll always have something within your 45 days to look at. So a lot of DSTs have, or I should say, DSTs have saved a lot of exchanges where somebody has had problems finding replacement property, and there's a DST that's available that they choose to identify and use as their replacement. What people love the most about them, the number one reason people love them, is it eliminates the management responsibilities. No more headaches, no more phone calls, no more tenants, no more calls in the middle of the night for toilets overflowing. That's what people love the most about them. There is monthly income. There's a dividend that gets cut every month. And obviously the long-term non-recourse financing, which we talked about. So in saying all of that about DSTs and how wonderful they are, there's some downfalls. And these are the reasons that people typically don't like DSTs. I should say, really the number one is that there is no control. So once you put your money in, you have no control over when it comes out. So that really is the number one issue. It could be held for 3 years, it could be held for 5 years, it could be held for 7 years. Really, the goal of the sponsor is to purchase these properties low, hold on to them, make some money for their investors, and then sell them higher. Now, if they buy high and the market takes a little bit of a dip, they may be holding on to these properties for a little bit longer than they normally would, because they don't want to take a loss on them. So the timing is probably a number one concern for the clients, and how long the property is going to be held. But all of these issues are factors when considering 1031 exchange. You cannot contribute any further capital once the DST is closed. DST cannot renegotiate any loans. So whatever they locked into yesterday at the rate is what it's going to be for the duration of that holding. What else are the big downfalls? I'm just kind of looking through the list. So you can't use that cash for any other reason. So you can't pledge it or do anything. It's literally tied up in the DST. So those are the real big issues on the DSTs. Does anybody have questions about those? I know I just threw a ton of information at you. We work with multiple DST companies that provide solutions, that provide all sorts of solutions. So, we have people that specialize in just DSTs. We have financial advisors that really look at a holistic approach and work with the clients on all of their investments. And then we have everything kind of in between. So we're happy to make those referrals. It's not something that I sell or I do. We are just the qualified intermediaries helping you through the exchange and the process. We refer you out. Any questions about that? I see some mics kind of going on and off, but okay. So I'm going to move on to triple net lease properties. So a triple net lease property is another really great alternative for replacement properties. A triple net lease is typically a single tenant property where the property is 100% leased to one tenant and they're responsible for the entire property. They handle all the insurance, all the maintenance, all the taxes, everything. So if you're trying to move away from the maintenance of being a landlord, but are not willing to give up control into a DST completely, triple net lease properties are a great solution for that. There's a lot of them on the market. A lot of commercial brokers will be able to show you portfolios. And what's nice about the triple net lease properties is that you can buy something really anywhere in the country. So it really doesn't matter where it is because your tenant is taking care of the property as if it's their own. So that's really a great solution for a lot of clients. And what's nice about triple net lease properties, what people like about them is that although they're not liquid, I mean, obviously you're buying a bricks and mortar property and it's not a liquid investment. There are always buyers out there. So good brokers will always say, we can get you into a property, but we can get you out fairly quickly too. So they can always find a buyer for that property as well. So, a lot of them will say that they're liquid 60 days out. So it's a good solution and it's a nice blend between the DST and being a landlord. The second bullet point, it says triple net lease properties are good investments. Triple net leases are considered to be one of the most secure investment opportunities. This is because similar to bonds, single tenant net lease properties provide a steady and predictable return over time. And the downside for landlords who are locked into a long-term lease, they lose the ability to increase the rent if the values in the area increase. So in the long term, it can limit their income potential. And that's something that everybody just kind of takes into consideration and factor when they're talking about their triple net lease properties. So we talked a lot about different types of properties. We talked about vacation rentals, we talked about DSTs, we talked about triple net lease properties, and we talked a little bit about what it's like to, just buy another bricks and mortar property, just buy another single family house, multifamily house, condo, something that they want to rent. So we're going to just get back to the actual exchange. And I probably should have put this in the beginning of the slideshow, but when we're talking about identifying properties, and remember we have that 45 days to identify replacement properties, there are 3 rules to identify. And you have to follow one of these 3 rules, whether you're buying a triple net lease, whether you're buying a DST, whether you're buying a bricks and mortar property, it doesn't matter. You have to follow one of these 3 rules on how to identify. So you're going to pick one, depending on what your plans are. The first rule that you can choose from is the rule of 3. And that says a taxpayer may identify up to 3 properties at any market value. It doesn't matter how much the properties are worth. And you can purchase 1, you can purchase 2, you can purchase all 3 of those. The second rule is used typically if you are diversifying. You're selling one property and you're buying multiple properties. If you are selling one property and you want to buy 5, well, the rule of 3 is not going to work because you can only identify up to 3 properties. So the 200% rule, that's where this comes in. The 200% rule says the taxpayer can identify an unlimited number of properties, but the total, the aggregate fair market value cannot exceed 200% of the property that they sold. So if you sell for $1 million, you can identify $2 million worth of properties. It can be, you know, 10, $200,000 properties. It can be, it doesn't matter. It just, they cannot exceed 200%. So, and that's used a fair amount. We have a lot of people that are like, the 3 just doesn't work. I need more because I'm deciding between multiple properties. So the 200% rule we use a lot. The 95% rule is used for very specific cases. So this rule says you can kind of forget about the 2 rules before you. You can identify an unlimited number of properties for an unlimited value. It doesn't matter how much they are and how many properties you identify. But once you do that, you have to purchase at least 95% of what you've identified, which is, let's call it what it is. It's 100%. You have to identify, you have to purchase 100% of those properties, even though it's 95%. So it's used in very specific cases when people know exactly what they're buying and they know that they're guaranteed to purchase all of those properties. It's also used in cases where DSTs may have multiple properties within their portfolio. So you may be buying one DST, but it might have 4 properties in there. So 95% rule sometimes falls into when you are identifying DSTs with multiple properties as part of your replacement properties. So I don't know if there's any questions on that. A lot of people talk and ask us this question. I get this question every single day. How long do you have to hold your properties? How long do you have to hold your relinquished property? How long do you have to hold your replacement property? And unfortunately, I can't give them a great answer in saying 2 years, because the IRS doesn't give an exact time frame on how long you hold your properties for, or how long you have to hold, what the requirement is. All they tell you is that your intention should be that you were holding your property for long-term gain. So you should have held your relinquished property for long-term, and your intention when you purchase your replacement property would be that you were holding it for long-term investment. And there's a lot of factors, there's a lot of circumstances. So sometimes people come to us and say, you know what, I bought this house 6 months ago and I need to sell it. I need to exchange it. And after talking with people, that may be okay. Even though they only held it for 6 months, they may have fully intended to own this property for a long period of time. They took out a 30-year mortgage, they had a 5-year prepayment penalty, they had a tenant sign a year lease, and 6 months into it, some extenuating circumstance happened and they have to exchange it. And the IRS is going to be okay with that if you can prove that your intention was to hold it for long-term gain. So in saying all of that, we always tell people, try to hold it for 2 years. That's kind of the conservative recommendation, but there's always gray areas because it really does come down to intention. The only reason we say 2 years is it from QIs, from qualified intermediary standpoint, it means that the exchange kind of went old and cold. There are some regulations and safe harbors that mention 2 years. So that's kind of where that 2-year comes in, but it really comes down to intention. And like I said, right at the beginning of the presentation, you will file your exchange in the tax year that you sell your relinquished property. So if it overlaps in 2 years, like it may now, you can you're going to file this 8824 form, which is your like-kind exchange form with your taxes in the year that you sold your relinquished property. We do not complete this. Qualified intermediaries don't complete this. Typically your CPA does, but we provide all the information at the end of the exchange for you to be able to fill this out. And just a quick little tip that we give everybody regarding qualified intermediary due diligence. Make sure when you find a qualified intermediary that you ask these questions. And we can send this presentation out, but certainly ask these questions. How are the funds held? You know, what are the requirements for withdrawing the funds? What do those processes look like? Is fraud protection part of qualified intermediaries' business? Are they audited by an independent third party? Are they members of the Federation of Exchange Accommodators? These are all things that validate qualified intermediaries, because the reality is qualified intermediaries are not all created equally. We are bank owned. We are owned by Northern Bank. We are based in Woburn. I am based in Woburn. The bank's been around for more than 60 years. We've had the qualified intermediary company for 7 years now. So we are diligent in what we do.